Thank you everyone for coming today. What we're going to run through today is what COVID-19 really means for the property market, particularly having a focus on the developer segment. In terms of realestate.com.au, we're all working remotely at the moment, so we apologise if there's any technical issues, not that we foresee any, but we're all using our home internet and things like that, so there may be some issues as we go along, and we do apologise. But we felt it was really important for us to get on the front foot and come and talk to our customers in a timely manner about what's happening with the property market, what COVID-19 means, and what the outlook is over the next few months. If you want a true view of how we see the market, there's a lot of opinion out there, but go to the news section of the realestate.com.au website, realestate.com.au/news, and there's a dedicated coronavirus section there. And that has all of our articles and news that we're publishing about what COVID-19 is, what it means for the property. I'm sure, as you can all appreciate, it's a very fluid situation. Reporting's changing hour by hour, day to day. Last night, obviously, Scott made an announcement about further shutdowns that are taking place. But we're doing our best to stay across all the news, determine what it means, and publish that out for you, our customers, but also the consumers out there in the market. So if we jump in and move on to the first slide, I think the immediate impact is just that a whole range of sectors of the economy are being impacted. The tourism sector has been quite hard. Essentially, no overseas tourists can come to Australia anymore. So generally speaking, Australians can't really travel at the moment. They send across borders into other states. This is coming on the back of tourism of the bushfires at the end of the year. So the tourism sector has been particularly hard hit. Essentially, for the most part, it's actually down. The higher education sector has also been fairly hard hit. A lot of overseas students, particularly from China, that our universities have become reliant on, can't come to Australia, and that's having a revenue because a lot of these overseas students do pay larger fees than local students, and they pay those fees up front. And now they're increasingly the entertainment industry, restaurants, bars, cafes. Restaurants, bars and cafes, well, bars are basically shut down. Restaurants and cafes can still open, but have anyone eating food inside the restaurant or cafe. So it's all about takeaways now, which means they need a lot less staff. And then discretionary retail, we saw last night, nail salons and these kind of places have been shut down. Gyms have also been shut down. And unfortunately, that means that a lot of people are basically overnight out of the job. A lot of those people are contractors. A lot of those people work part-time and now won't have any hours. And that's the real challenge with this crisis at the moment, that it's not an economic crisis, a health crisis, but the impacts of the health shutdowns are having a big impact on the economy. And as a result of that, we'd expect the unemployment rate to start to rise. For the real estate sector, we obviously saw that open homes and auctions are now banned. So that's making the selling process more difficult. Good news for the developer segment is developers are generally, for the most part, selling something that doesn't yet exist. You can't touch it, you can't feel it. It's much more challenging in general real estate, who are used to being able to take people through homes. People can go and open drawers. But I think it's a really good time for the sector as a whole to innovate. Looking at wars of properties, looking at taking auctions offline. I think there's some great opportunities here for the sector to innovate. And I think that the important point is the property market is not closed down. It's still open for business. Banks are still very willing to lend. But ultimately, the challenge at the moment is confidence. Businesses and consumers are nervous. There's so much we don't know about COVID-19. We don't know if we don't know what's going to happen to our business. Are we going to lose our jobs? This is creating nervousness, and particularly for property, it's a very high commitment, high confidence purchase decision. So that's likely to lead to people being less inclined to go and buy and sell property. Now, is there any good news? There is some good news. China, their economy is starting up again as the COVID-19 fears reside. And that's good for Australia because China is our biggest export partner and our biggest import partner. So we do a huge volume of trade with China, and if they can get their economy back running, that will be positive for our export sector, particularly which is projected to be Australia's first commodity to top $100 billion of export earnings in a single year. Another thing really helping the Australian economy, along the fact that the Australian dollar is so weak, that is going to provide a lot of assistance to the export sector, particularly again with China pegging their country to the US dollar. We're very weak against the US dollar. And then finally, there's just a huge volume of economics now in place. So because this is a health crisis, a lot of the people that are impacted by this and are losing their jobs at the moment, those jobs, once the recovery starts, will be needed very quickly. So I would suggest that a lot of these jobs will come back into place quite quickly once the community gets back to normal. On top of that, we've got interest rates the lowest they've ever been. And we've had the Reserve Bank basically say that they're not going to lift interest rates until they can get the unemployment rate down towards full employment, which they haven't been able to do before the crisis, and until they can get inflation comfortably within the 2% to 3% annual range, which again, they haven't done for more than 4 years in the lead up to this crisis. So it's reasonable to expect that the low interest rates are going to be here for a very long time. And when the recovery does start, people are going to want to go and borrow. People are going to want to go and sell because they've been in their houses for such a long time, and that's going to be positive for the economy in our view. If we go to the next slide, how do we limit the impact on the property sector as a whole? I think mainly it's about people employed, and if people do need to be laid off, trying to make those layoffs temporary. You know, can you stand down from the job for the next 3 to 6 months? And then the governments really need to provide that level of assistance. Households can continue to feed themselves, can continue to pay the rent, can continue to pay the mortgage. And the government is providing support there. We still haven't heard anything on rent, but certainly with mortgages, we've heard some support there, largely from the big banks. We need to ensure that firms can get through the next 6 months without going bankruptcy. And again, the Reserve Banks and the government's help here with some, particularly for small and medium-sized businesses. We also need to support the system as a whole, ensuring that non-performing loans don't mount so it doesn't actually become a full-blown financial crisis. And again, the government stepped in to try and help there. We also need to provide support for mortgage holders and renters, particularly those that lose their jobs or have their hours reduced. Now, there's been a lot of announcements. Unfortunately, no one's actually received any money yet. And this is probably the thing that is really concerning for me, that people lose their job and they need that money straight away. There's a lot of people out there that live week to week. They can't wait till April to have this money. They need it right now. And I think it's a little bit unfortunate that those things are moving quite slow. Obviously, one of the other big things is keeping the public safe and reducing the risk of infection. But for the industry, just being proactive and finding ways to keep activity going, whether that be virtual tours, online auctions, or something like that. But I think the key point is right now, this is a health and productivity crisis that will lead to a short and sharp downturn. The finance sector is in good shape and open for business, but keeping the economy going is really the priority, which will limit the impact on the property market. If we now look at the next slide, what could a post-COVID-19 world look like? As we just said on the last slide, we think that the downturn is likely to be short and sharp. It looks pretty likely that the economy is going to go in a recession. And that's not unique to Australia. That's pretty much the world economy is going to be going into a recession on the back of COVID-19. But really, the factor is that the government stimulus can cushion us somewhat from how tough those conditions are going to get. And we already know that there's been 2 stimulus packages, and the government has flagged that there is another one likely to come as well. There's a high level of stimulus globally, which should lead to ultimately a fast recovery. Again, it's not an economic crisis, it's a health crisis. So a lot of these workers that have been laid off, there'll be demand for those workers once we get back to business as usual. The first 2 rounds of stimulus have been fairly light touch for property. They've been more about supporting the economy and keeping people employed. I read in the AFR this morning that a lot of the development leaders are actually going and speaking with Michael Sukkar, the housing minister. So maybe that third package will have some form of stimulus for the housing market. The low cost of borrowing will really help the property industry, particularly as we start to recover, and the fact that the Reserve Bank has flagged that interest rates are going to be at that level for some time. The cheapest borrowing costs you're ever going to have. So once confidence comes back, I would expect pretty strong demand for the property in property. Potentially we'll see more forms of quantitative easing and moves to ensure that workers are kept in place, and we're already seeing that. So I think with such a coordinated effort, not just here in Australia, but around the world, we have the potential to see a rapid level of growth, economically speaking, but also potentially housing market speaking, post the COVID-19 crisis, very similar to what China saw after the SARS crisis. So if we jump onto the next slide, I've got a number of slides here which talk about the impact on different segments. Now, I'm not going to go through all of them, especially because we had to restart, but I might touch on residential and then talk specifically about developer. So in terms of residential, currently things have been holding up fairly well. Clearance rates weakened this weekend, but they remain high, and we're still seeing a high volume of auctions. Now, that's likely to change over the next few weeks. I was actually surprised how strong clearance rates held up last week, given what we'd already seen. And now we've obviously got a lot more stringent rules around auctions and open for homes, and that's going to have an impact. We are seeing on our system a bit of a fall away in search behaviour, fewer searches happening on realestate.com.au, but it's still much higher than it was at the same time last year. Again, that's probably going to slow, but I think it will be interesting once we, over the next few months, I actually think search behaviour could increase because people are essentially being told to stay at home and not go out. And we know that Australians are really obsessed with property. So for someone that might be thinking about buying a property, they could spend the next few months at home really heavily researching property and making a decision about where it is they're going to want to move to next. And then once the market starts to recover, go out and actually execute on that plan. Auctions and open homes are now banned. So agents are going to have to proactively look at new ways to list and sell homes. Stimulus and interest rate cuts, though, are making it a very cheap time to buy. The market is not likely to be anywhere near as volatile as the equities market. There is that mantra of safers, but also people need somewhere to live. And I think more so than anything else, we'll just see people stopping trading properties over the next few months. There's also obviously the opportunity to buy in a downturn and sell in an upturn. So maybe people will see this as a good buying opportunity. I think there's some concerns that job losses could impact on renters as well as lead to distressed sales. There's less of an impact from that if these concerns are mitigated. So really, I'm still worried that there's been nothing announced for the rental market. Renters spend a higher proportion of their household income on housing costs than mortgagees do. So, and you think about the profile of people that are renters, they're contract workers or part-time workers. They're the ones that are really facing immediate layoffs and need some help now. And what can we take from previous downturns? The negative impacts are really linked to people losing their jobs. So if the government can get a package that actually keeps people employed, or if they're temporarily out of employment, keeps money coming into them, then that can minimise the impact on the property market. Post COVID-19, cheap access to finance. We think that will lead to a strong recovery and pent-up demand if we do see a slowdown, because people will be thinking about what their next property move is. In terms of new development, it's kind of similar. Stimulus is making it a very cheap time to build and to buy. Also, for probably not the larger developers, but some of the smaller developers, you've got access to very cheap finance at the moment. Potentially some issues with materials coming out of China, given the shutdown that we've had there, but obviously that economy is starting to come back online. Construction activity is potentially going to be longer term impacted by self-isolation measures. Building sites at this stage are still open, but given how this is progressing, there is the possibility that building sites will be shut down at some point in the future. Display suites, obviously you can't really have people walking through them anymore, so that does create some challenges in the selling process. There may be some switch away for equities to new homes with the panic in the equities market. potentially people start to look at going and buying a new home as an investment rather than going and buying equities. Probably there will be some drop off in activity as people reassess their investment decisions, and probably not a lot of demand coming from offshore at the moment. But, you know, post, again, very similar to the resi market, strong recovery, cheap access to finance, may see a longer term switch away from other forms of investment to housing. And I think overall we need more housing. Although population growth to Australia is going to slow in the short term, we're going to see, once the economies start to open up again, you know, I think we'll start to see quite strong overseas migration into Australia. I think also if we can contain the COVID-19 better than most other countries, I think, you know, we always talk about the tyranny of distance, but that might actually be quite appealing for people. You know, if people are worried about health concerns going forward, worried about future pandemics, maybe Australia becomes more attractive because it has got that isolation factor. We can shut down our borders more effectively than other countries, like, for example, in the Eurozone. So that may create more demand for housing down the track. If we then go on to the next slide, I'm going to jump ahead a few slides. I'm not going to touch on the office sector, industrial, retail, medical. Very quickly, I'm going to touch on what has the response been from the federal government. The first stimulus package, and I'm not going to go through this in detail, but essentially the first package, 17.6 billion, very quickly we discovered that that wasn't going to be large enough, but it was really all about supporting small and medium enterprises and trying to ensure that people can actually stay employed. Now, that's not necessarily being that successful, but it's also about creating a safety net for people when they do lose their jobs. If we then go to the next slide, in terms of the second stimulus package, it's been much larger. And again, really, it's been all about supporting people that lose their jobs and trying to encourage people who, or businesses rather, that are finding tough times, giving them access to the finance that they need to continue to trade throughout this period and really help them along that journey. If we then go on to the next slide and have a look what's happening there from the Reserve Bank, they really did four measures. They cut the cash rate to 0.25%, and essentially the cash rate at 0.25% means that it can't go any lower. So policy rates are now in line with what we're seeing in the US, UK, New Zealand. So they've been aggressive in cutting those interest rates. As I said earlier, they've also noted that what they're not going to do is move those interest rates until they're making some real progress towards full employment and some real progress towards inflation being between 2 and 3%. And they're saying that is going to take at least 3 years, but given the track record prior to the COVID-19, I think it could be a bit longer than that. Because they are targeting interest rates at this level for 3 years, they're going to go and buy Australian government bonds. And basically what they're doing there is keeping the cost of borrowing for the Australian government low by driving down that bond price. So meaning that the borrowing costs are very low. They're also setting up a term fund facility for the banking system that supports the credit to small and medium businesses. So essentially what this means is that the Reserve Bank lenders with access to mortgage rates at 0.25%, and they'll have at least access to at least $90 billion in funding each. But the real feature of this is if they lend to large businesses, they're going to be, for every $1 that they lend, they're going to be given access to another $1 of funding. And then if they lend to small and medium-sized businesses, every $1 that they lend to small and medium businesses, they'll be given access to an additional $5 funding. So it's really an incentive for them to keep, they're reducing the cost of borrowing for lenders, but they're also giving them incentives to continue to lend to their customers. And then the final one's a bit of a wonky sort of thing, but essentially the way the banking system works is when you get to the end of the day, you have to have a certain amount of cash on hand. And what trading banks do is if they have excess cash, they'll deposit that with the Reserve Bank overnight. And if they don't have enough cash, they'll borrow that from the Reserve Bank overnight. And typically what happens is when you're depositing with the Reserve Bank overnight, you get given the interest chart. You receive interest at 25 basis points below what the cash rate is. So at the moment, with the cash rate at 0.25%, that would mean you get no interest. So they've actually changed that now to 10 basis points. So you get 10.1% interest. If you're borrowing from the RBA overnight, you are charged interest rate 25 basis points above the cash rate, so 0.5%. It's again a bit wonky, but essentially what it's saying is people can still get some return, well, banks can still get some return if they're depositing with the Reserve Bank overnight. If we now go to the next slide, what's the response been from the Big Four? So it's pretty clear that the government has been talking with the banks, and they've come out with support packages as well. So for individuals, they're significantly decreasing rates to fixed rate mortgages. Interestingly, most of the Big Four lenders haven't passed on cuts at all, or they haven't passed on full 25 basis point cuts to variable rate lenders. So it's pretty clear that they're trying to encourage borrowers to go and fix their mortgages for the next period of time. They're also offering mortgage deferral options for people affected by COVID-19, up to between 3 and 6 months. But depending on how long this drags on, I would expect that those get expanded. And they're increasing term deposit rates for savers. So they're finally doing something to help those people that are reliant on savings rather than trying to pay a mortgage. And then for small and medium businesses, similar kind of moves, reductions in interest rates for new lendings, reductions on interest rates for overdrafts, assistance with financial hardship, and options for deferral of repayments on small and medium enterprise loans. So if we jump from there into some of the economics and housing market trends, I think it's important to realise that sales volumes were quite low prior to this downturn anyway, and they were actually trending lower on an annual basis. I think it's reasonable to expect from here that we are going to see fewer transactions out there in the property market, whether that be people going and buying brand new homes or brand new apartments, or people buying existing homes. It's pretty unlikely that sales volumes are going to lift, at least in the short term. Longer term, I do think that we're going to see quite a strong rebound as we start to recover from COVID-19. But in the short term, I think buying and selling properties for a lot of people is not going to be the #1 priority. It's going to be about jobs and keeping their families healthy. It is the #1 priority at this stage. In terms of prices, property prices had been starting to rise again. It's a bit hard to see here, but if we look at the GFC downturn, for example, prices in Sydney fell about 15%. In Melbourne, they were about 9% lower, and similar falls in Brisbane, Adelaide, and Perth. So if we look at the track record, even if these recessions or these economic downturns are not really driven by finance or the housing market, I think it's reasonable to expect that we are going to see some price falls. I think the big difference here is that, again, it's a health crisis, and once we start to recover, I do believe very strongly that the housing market will start to recover quite rapidly as well. If we then go on to the next slide, and now we're getting really into some more of the economics of things. Up till now, Australia hasn't had a recession for 29 years. Even during the financial crisis, we didn't slip into a recession. But I think it's looking more and more likely that there will be a recession this year, particularly when you consider what's happening with the unemployment rate, the fact that businesses essentially a lot of them just can't operate anymore. So there will be an economic slowdown. No one wants that on the resume, and realistically, this isn't something that's due to the government of the day or anything like that. It's really a health crisis that no one saw coming. Perhaps we didn't take as seriously as we should have early in the piece, but it is going to have an impact because of how hard businesses are being hit in this downturn. And I think this chart that was published by ANZ, the ANZ Roy Morgan Consumer Confidence Index, which comes out weekly, really highlights that. Confidence fell about 27.5% last week. They haven't got a long time series on this chart that they produced, but confidence is now lower than it was any time during the GFC. And the last time it was this low was during the 1991 recession, and ANZ noted that it was only slightly lower at its worst part during the 1991 recession than it is currently. So this is really the crux of the issue. People just don't know what's happening, are not confident, and are really worried about what's going to happen. And when people are in these conditions, they're much less likely to go and buy and sell properties. So if we can make some breakthroughs, if we can start to find some medicines that are effective at treating COVID-19, if we can start to get some good news about preventative medicines, that will make a huge change to consumer confidence. And I do think once we start to make some progress, confidence will really start to bounce back quite quickly. If we look at the next slide, inflation, I've kind of touched on inflation. Inflation has been very low for a long time. The Reserve Bank prefers to look at underlying inflation, and underlying inflation has not been within their target range, which is in the grey there, 2 to 3%, any time over the last 4 years. So even before COVID-19 came along, we weren't successful at having inflation within that target range. So you can see why I'm saying interest rates are probably going to be on hold for quite some time, because it's going to be difficult to get inflation back up to that 2 to 3% range. If we then go on to the next slide, obviously just tracking standard variable mortgage rates over the time, they're now the lowest that they've ever been. And that was in February. That was before the 225 basis point cuts we got in March. So the cost of borrowing is extremely low, is extremely favourable to people that want to go out and borrow, but people are generally lacking that level of confidence to do so. But again, once that confidence starts to recover, I think that we'll see a lot of demand. And we know that historically the relationship between interest rates and the property market is, as interest rates come down, demand for property goes up and property prices tend to rise. If we then jump onto the next slide, this is the one that's probably a little bit ugly reading. So this is looking at the unemployment rate and the participation rate. So if we look at the 91 recession, the unemployment rate actually, before the recession, the low point isn't showed here, but it was about 5.5%. You can see that it jumped to 11.1% in that recession, and 11% unemployment is what a number of different economists from some of the major banks are predicting in this recession. The other thing you can see is the participation rate fell quite dramatically. Now, the participation rate is people that are employed or people that are actively looking to be employed in the market. So you can see that over recent years, the participation rate has increased dramatically. The unemployment rate's been sitting at around 5%, but I think it's reasonable to expect that that's going to start to increase. Even during the GFC, although that was it wasn't technically a recession and it wasn't a long slowdown, we did see the unemployment rate jump from 4% to 5.9%. And we've never got anywhere near close to 4% again since the GFC. If we go to the next slide, looking at building approvals, I think we know that there was a huge amount of approvals that came through the system over the last 5 or 6 years. And increasingly, there was a move towards higher density apartment approvals as opposed to detached houses. But we've also seen that fall dramatically. And we may see that pull back even further over the coming months. The challenge with that, though, is that the longer we continue to not approve a lot of new buildings for construction, then we run the risk of coming into a deficit of properties further down the track. And we know that that is the kind of conditions that are conducive to prices rising fairly quickly. And I think really the challenge with development is when you need stock, you can't create stock quickly enough. And when you don't need stock, you can't really stop it coming online, particularly with apartment development. And you can really see that in this next chart. At the end of the September quarter, and the data is pretty lagged, unfortunately, from the Bureau of Statistics, but at the end of that quarter, there was 140,000 apartments still under construction nationally. Historically, at the end of any given quarter, the average is about 38,000. So it really shows you the quantum of stock under construction nationally. Now, this still all has to come up for completion, has to settle. So I think that's why there's a reluctance from developers, and obviously it's all developers on the line, so you'll know better. But I think people want to see this amount of supply under construction moderate a bit further before they're prepared to go and start building new stock. And obviously COVID-19 really throws a spanner into the works with all of this as well. If we then go to the next slide, this is looking at housing credit growth. It was fairly sluggish prior to the onset of COVID-19, but owner-occupier credit was starting to expand. Now, I would expect that we're going to see credit growth shrink over the next little while as demand for mortgages starts to slow up a bit. And that's really been one of the features, really since the federal election of last year. We saw the confidence really returning to the market. Investors were prepared to go and borrow again. Subsequent owner-occupier purchases were confident again. And first home buyers were really ramping up. I mean, there is still a lot of stimulus for first home buyers, but I do suspect that we're going to see a pullback in first home buyer numbers, because generally it is those younger people early in their careers that are more susceptible to job losses in an economic downturn than the older employees. But whichever way you look at it, I would expect that we're going to see fewer people seeking finance over the next few months. But again, I think once the recovery starts, we'll see the monthly value of housing finance commitments ramp up very quickly right across the board. If we then go to the next slide, retail trade, it's interesting to look back at the last recession, because even in that time, retail trade was still growing. Retail trade's been fairly sluggish over the last few years, but the nature of this crisis is that so much of the retail sector simply has to shut down and can't trade anymore. Even through a recession, people can still trade, but there's so many people that can't trade. And this is really going to be over the next few months. I think we'll start to see this come to fruition, particularly once we get the March data, that we're going to start to see a fall in retail trade. All the reports so far, that some of the banks put out regular data on retail, and they're saying, the panic buying is holding retail trade up at the moment, but you would think at some point the panic buying is going to stop, and then the other segments of retail, particularly as people can't go out to lunch and breakfast and dinner, people can't go out to the shops like they used to, that's going to start to have a more severe impact on retail trade going forward. But again, I keep harping on about this point, but I do expect once we get a solution, once the economy starts turning back on, we're going to see a fairly rapid rebound in retail trade. I mean, my wife and I, one of our favorite things to do is go out to breakfast on the weekend, and we can't really do that at the moment. I can guarantee you, once we can start doing that again, we're going to be very keen to do that. And I imagine there's plenty of other people out there that are in the same boat. And then if we look at the next slide, population growth, really housing demand is driven by migration. And nationally, that's net overseas migration, but at a state level, you've also got interstate migration. But what this crisis is really creating is conditions whereby people can't move between states at the moment. People from overseas can't come to Australia, and Australians can't go and travel overseas. So, the first couple of quarters, you'll probably still see some net overseas migration over the first quarter of 2020, but certainly by the second quarter, it's basically going to stop completely. So that's going to be a challenge for the market. But again, once the recovery starts, I think we're going to see some net overseas migration quite strong. As I mentioned earlier, the fact that we are isolated, that at the moment we're containing the virus a little bit better than some of the other parts of the world, that we have a free healthcare system where some other parts of the world don't. I mean, there's some pretty appealing aspects coming out of this for Australia. And if we look at the next slide, which is basically just tracking our debt, and this is the concern with job losses and with potential housing market downturn, that we are heavily indebted. It's encouraging that the banks are offering people mortgage holidays. And I hope they can continue to do that throughout this crisis. But again, we don't know how long this COVID-19 crisis goes on for. And really, the value of the assets is much higher than the value of the debt. But the problem is, in a downturn, if property prices start falling, obviously a lot of people have seen their super balances fall quite substantially. People that own equities in their own right outside of super have seen their household wealth fall as well. When the value of the assets falls, the debt doesn't always also fall. So that's the challenge when we look at the high level of household debt, and a lot of that contributed to housing here in Australia. And then just for my final slide, I kind of wanted to summarize all of this and bring some context to what it means. I think there's definitely some short-term pain out there in the market. I think people's health is much more important than anything else. We need the government to really support workers that lose their job. And hopefully we just start to find a solution, some drugs that start working on COVID-19. But I think there's definitely some positives and some confidence that we can take out of this. The challenge at the moment is housing's an asset class that thrives on confidence, and people are just not confident at the moment. They're worried. But longer term, as the recovery starts, mortgage rates are the lowest they've ever been, and they're likely to remain at those levels for quite some time. Property transactions can still occur. Agents just need to be proactive and look at alternatives to traditional inspections. And as I said, I think the development sector in particular is well positioned here, because developers and the salespeople that work for developers sell a dream. They sell a product that doesn't actually exist. So I think that's a real challenge or a real positive for the developer sector, that they do have these differences to what we're seeing across the residential agency segment. The volume of stimulus in place means that we expect the economic rebound post-COVID-19 to be quite strong. Also the fact that, pardon me, I've been talking too much. Also the fact that a lot of people that have been laid off through this period will be needed by those businesses quite quickly after the recovery starts as well. The banks have repeatedly said that they're open for business and ready to lend. It's just giving people the confidence that it's actually a good time to be going and borrowing off banks at the moment. And that's the challenge. But I think more broadly, people are going to have a lot more time on their hands, time to go and research property, consider their next move. And I think for developers, it's important to still be promoting your projects to these customers throughout this period, because whilst they may not be transacting now, when things do start to turn, when the confidence comes back, they're going to be very interested in going and buying properties. And they're going to have had a lot of time to do research. So it's really important to still be communicating to this sector. And then just finally, the dramatic fall in the Australian dollar is going to be very stimulatory for exporters longer term. But at the moment, as I said, there's a lot of global uncertainty. People are losing their jobs. Economic growth is going to slow. But all we can really hope for is that the government and the Reserve Bank continue to provide stimulus and support for individuals and businesses, particularly those individuals that lose their jobs, and particularly those businesses that are facing shutdowns. That's it from me. I did want to say we did have some technical issues throughout. I've just been told, and I do apologise, but we'll make sure that you have access to those slides during the recording. Again, sorry for that. I do think we have some time for questions, if there are any. I haven't received any questions yet. If you want to send them through on the channel, the team here will send them through to me individually as well. So slide 6 was the impact on new development. Obviously a pretty important slide. So the immediate impact was that stimulus and interest rates are making it very cheap to build and buy, and that's going to continue to be in place for some time. There may be some issues with materials coming out of China, but again, that economy is starting to come back online. To date, projects are still going ahead. There's still people going out and building at the moment, but construction activity may be impacted by self-isolation measures and potentially some shutdowns in the future. Display suites are now shut down, so the selling process is becoming a little bit different to how it has been in the past. But I think there may also be some switches away from equities. People see houses as a much more stable and less volatile investment choice, and people still need somewhere to live. There may be some temporary drop-off in activity as people assess decisions, and obviously offshore, I think we're likely, in the short term at least, to see less demand for offshore, but longer term, we could see a big return of the offshore demand. And then post-COVID-19, I think I've touched on this a lot through the presentation, but a strong recovery because access to finance is very cheap. We may see a longer term switch away from other forms of investment to housing, and we need more houses. Australia's a growing country. We do invite in a lot of people from overseas, and they need somewhere to live. And the longer we continue to not build very much, then that's going to create some undersupply issues down the track. Your questions are now starting to come in, so I'm going to read some of those questions out and do my best to answer them. So, can I share any lessons from overseas markets who are ahead of Australia? Specifically for the property market, not really. The challenge is that a lot of the data is actually quite delayed getting to us, so it's hard to get a view. But I think a lot of the areas that are ahead of us have essentially locked out their economies for a period of time, and obviously that does have a big impact on the whole economy. You know, jobless claims in the US and Canada went through the roof last week. We haven't got the latest data yet, but it's likely to do that again. So this is a real challenge that the whole world's facing. So it's not going to be immune. I mean, we're lucky at this stage that the whole country hasn't actually gone into a lockdown, and I certainly hope that that doesn't happen. But I think we have to be prepared for the possibility that that might happen. Another question is, what can we say to buyers that will bring some calm and encourage them to proceed with their purchase? I think the main messaging just has to be that this is a short-term health crisis. It's not really linked to the economy. It's not linked to the property sector at all. You know, we've got the best scientists in the world all working on how we can solve this problem. And realistically, it's probably going to be a short-term thing. And once we do start to recover, housing demand is going to be very strong. It's going to be pent up. The cost of borrowing is the lowest it's ever been. So outside of what's happening with COVID-19, the situation is quite positive for the housing market. What are my thoughts on the market's likelihood of appetite to purchase off the plan with uncertainty of being able to sell their established property? Well, I think that's going to be a bit of a challenge at the moment. If people don't feel like they can sell their established property, they're going to be less inclined to move to the off the plan property in the short term. So I think given that, maybe the target of the off the plan segment needs to be more on first home buyers or investors at this stage, rather than people that are downsizing or selling out of an established property and moving to a brand new development. But again, keep harping on about it. Once the recovery starts, there's going to be a lot of demand for established properties and a lot of demand for brand new properties as well, I feel. Question, do I feel that job losses could threaten off the plan property settlements? A few have UNCO, UNCO finance, until unconditional finance, until the properties are basically nearly completed. I think it could be a potential issue. But again, I think the banks are trying to help people through that process. So I'm not sure exactly what that's going to mean if people have lost their jobs and are on a mortgage repayment holiday or settlements get called. I'm not really clear on that, but certainly I think that's a threat that is a good one to call out. Next question, if there is any. Let me have a look. That looks like it's all of the questions at this stage. I'll just wait a second to see if there's any more questions that pop through to me. But while I've got you here, once again, I want to say thank you very much for your time. Thank you for taking the time out of your day to come to this presentation. Hopefully, we've given you some insight into our view around what COVID-19 is, what it means for the market. But I think the key takeaway is that it's a short-term health problem. It's not an economic problem. And the amount of stimulus that's out there in the economy is going to see a fairly strong rebound in the housing market post-COVID-19. Okay, a couple more questions have come through. Do I reckon the bank loan restriction for overseas buyers will be eased to compensate the downturn in local demand? I doubt it. I think politically that's a tough one to ease at this stage, just because there is the view that overseas buyers come in and beat out local buyers, particularly first home buyers. So I don't know that they'd go down that track. I think if anything, there's probably going to be more stimulus for local buyers and potentially first home buyers. Have I analysed settlement risk for projects due to settle in the next 6 months? Not at this stage, but I think it's something that needs to be considered. We don't really have the data at REA to really assess that. But I think for developers, it's probably a good time to be proactively talking to the banks and also talking to the valuers now while you probably have a little bit more time on your side and see what can be done and how we're going to overcome these issues. The property sector as a whole really needs to come together at this stage and find some practical solutions. Another question is, what do I think the rent relief package will look like once it's put forward? I essentially think that the government needs to cover the rent for people that lose their job. I think that's what the package has to be. That's what some packages have been elsewhere across the world. And as I said, the people that rent are typically the most exposed to the kind of economic downturn we're seeing at the moment, whereby casual and part-time contract employees can't work. So I think that's what it will have to be. And I don't think that they can rely on giving investors mortgage holidays and then passing that on to the renters. I don't think that's going to be the case. The one thing I will say about the rental market, though, is I think that there's going to be more rental properties coming online over the next few months, because you consider how much rental stock has been pulled out of the long-term rental market over the last few years and put into Airbnb. Airbnb is basically completely unviable at the moment. So those people, I would think, are going to be looking for 6 to 12 month leases to tide them over while they can't get any of those short-term rentals in there. Do I feel like there will be more first home buyer incentives offered? My personal view is that I don't think that first home buyer incentives should be offered, but in saying that, I would not be surprised at all if the government do offer them, because they're very popular with first home buyers, and it is a way to get some activity moving in the market. My only concern about first home buyers incentives is they just tend to push the prices higher. So I personally don't like them, but I would not be at all surprised if we do see those incentives in place. I think that might be the end of the questions at this stage. But again, thank you very much for coming. I hope you got anything, you got some good value out of this. If you think of some more questions after we finish here today, talk to your account manager and we'll try and answer any of those questions that you might have. We've got another, no, that's the same question, sorry. Losing my mind a little bit here. I'm seeing that there's some questions being typed, so I'll just wait for those. Do I expect valuers to factor in the COVID impact and hence we see reduced valuations for current contracts? I guess for the valuers, it's really going to depend on what the instructions are from the banks, whether they factor that in or not. I think that if they're not told otherwise, they probably will factor that in. But, again, unusual circumstances, short-term economic impact, maybe the instructions from the bank are to disregard COVID and focus on the longer-term trends that we'll see post-COVID. So that's really a question for the banks, I guess. All right, I think we might call it there. Thank you very much.